Today I'll talk about one of the most basic skills you need to know before you learn how to invest or trade. I'm talking about market cycles. So before we get into today's video, here's a quick disclaimer for you. Alright, let's get into it. So what is a market cycle? A market cycle takes into account both technical and fundamental analysis and uses the security price to gauge cyclical behavior. Similar to the product life cycle that we all know about and learned in schools, a market also has 4 stages. First is the accumulation phase. Second is the uptrend phase. Third is the distribution phase. And fourth is the downtrend phase. So all 4 stages, individually or cumulatively as a whole cycle, can last from a few minutes up to a few years, depending on which time frame you are looking at. When you first look at a chart, the first thing you should do is always identify what stage is the market currently in. This will give you an advantage over other investors. So example, if the market is in a stage 4 decline, you do not want to be going long on the stock. If the market is going on an uptrend, you do not want to be going short against the stock. By knowing how to identify different market cycles, you'll be able to profit in different markets, different industries, and different time frames, as all of these have their own unique different market cycles. So, for example, when there was COVID lockdown globally around the whole world, stay-at-home stocks like Zoom, technology stocks, and healthcare stocks were on the up. But tourism stocks and aviation stocks like Booking.com, Boeing Airlines were on the downtrend. So to identify a stage 1 accumulation phase, here's an example. You need to look out for the following criteria. Firstly, you need to look at the price action and see that it's chopping across the moving averages and fluctuating around the 200 moving average. Secondly, you need to recognize that this is a stage 1 accumulation phase which comes after a stage 4 downtrend phase. The third criteria you're looking for is that the ratio of up to down days are about equal. For traders looking for market opportunities within stage 1, all you need to do is to look for the range and trade from the lows to the highs or vice versa. Next we have stage 2, the uptrend phase. So how do we identify stage 2? The following characteristics are: firstly, you need to see the price breakout from the stage 1 accumulation phase. Number 2 is that you want to see the stock price above the 200 moving average. And number 3 is that you want to see the shorter term moving averages like the 50 moving average and the 100 moving average are above the 200 moving average and are sloping upwards. So for looking market opportunities within the stage 2 uptrend, what you can look out for is to enter when the stock price makes a slight pullback to an area of value near a support level in the uptrend, and you can add shares there and ride the uptrend. Moving on to stage 3, the distribution phase, it is very similar to stage 1 and has a couple of similar characteristics. So firstly, you want to see that the price action is also chopping across the moving averages and fluctuating around the 200 moving average. Secondly, the ratio of up to down days are also about equal. And third, you want to see that the price action actually is tapering off and plateauing after the second phase uptrend. For trading opportunities within the stage 3 distribution phase, traders can look to trade the range itself similar to stage 1. Lastly, we have stage 4, the downtrend phase. So this is the polar opposite of stage 2, the uptrend phase. The first criteria you look for is when the stock price breaks down from a stage 3 distribution phase. The second criteria is that the price becomes below the 200 moving average. And the third is that the shorter term moving averages like the 50 and 100 moving average are below the 200 moving average and are sloping downwards. So for market opportunities in the stage 4 downtrend phase, you can look to enter at resistance levels and ride the downtrend by shorting the stock. Overall, understanding the big picture in the markets is very important before you zoom into shorter time frames to analyze the markets further. So just a couple of tips. Usually in an accumulation phase, which is a stage 1, I would tend to go short rather than long because the phase before that was a downtrend phase. And as such, I'm not sure if this accumulation phase is actually an accumulation phase or just a consolidation phase before the stock price heads further down. Likewise, during distribution phase, which is phase 3, I tend to go long with the stock instead of shorting against it, because the phase before that was actually a phase 2 uptrend phase. As such, I would not know if the distribution phase currently is actually a distribution or a consolidation phase before the stock price hits further up. Remember, the trend is your friend and markets generally follow the path of least resistance. Hope you guys enjoyed this quick introduction to market cycles and it helped you to understand the markets better. Please like, share and subscribe to our YouTube channel, and as always, may the markets be in your favour, and I'll catch you in the next one.